Dr. Abbott, thank you for joining us for this
It's a pleasure, Brian.
Emerging Leaders series.
Good.
You've been very involved with a great deal of research and education over many years with some luminaries in the profession, and it's a good opportunity for us to get to know you a little bit better.
I look forward to that.
Yeah. So tell us how you became interested in financial valuation, research, and a little bit about your education and where you're from.
Okay. Well, I took the normal route that most of the people you see coming into valuation. Very many people do not come straight out of college into this profession. Hopefully, gradually we are seeing among the younger generation. Mm-hmm. But in my, I would say, age group, I'm dating myself, we tend to come in through some form of banking, commercial banking, investment banking. That's where you see most of the people coming in from, other than the one that come through accounting.
Okay.
Okay. I was with a large international bank, managing a nice size portfolio of loans, primarily industrial loans, and came to Virginia Tech, Blacksburg, to get my MBA. Because I had reached a certain point, middle management, you need to move on, you need that boost up. While I was working on my MBA, I got offered a fellowship to continue into the doctoral program. Started that. Before I finished that, I got a couple of job offers in university teaching, and I started doing that. Mm-hmm. And that led to my looking at primarily, initially as I got interested, because my training is in corporate finance, okay, mergers, acquisitions. I got very interested in looking at the pump and dump kind of schemes that started in the 1980s. A lot of relatively small stocks were being touted out,
okay,
create a large volume, create a large price movement, and then once the distribution was done, suddenly they would disappear from the face of earth. No buyers, no sellers, the prices would plummet. That got me interested in looking at the relationship between volume and price for a publicly traded stock. That's where I started, okay, in this branch. Because before that, all my research had been in mergers and acquisitions, premiums that are paid and how the transactions are done, relative advantages of doing cash transactions, stock transactions. That's where my early work was. But once I got interested in this liquidity area, it became fascinating. Mm-hmm. And that kind of tangentially brought me into the valuation industry. I was making a presentation in Philadelphia on the cost as it changes between different forms, okay, of equity. Roger Grabowski. Roger was in the audience, and he asked me after that session. I did not know him at that time.
Okay.
I had not met him yet, and he said, "Can you come to Chicago for a day? I would like to sit down with you and maybe we'll talk." Mm-hmm. I said, "Sure, would look forward to that." And I went to Chicago, and that was my entry into the valuation area. He was working on a case, and he said, "Would you be available, interested in kind of working with me?" And that was really fun. He's a good, very enjoyable person to work with. And that's how it got started. One thing to another, you do something, somebody else hears about it, they call you, mm-hmm, word of mouth.
So that initial engagement or collaboration with Roger, are you able to talk about a little bit of what was involved?
It was a discount for lack of marketability. That's where it started, and then since my area is liquidity, that's where my research up to that point had been for about 10 years. So we are kind of making a distinction between marketability and liquidity. In business valuation profession, we have had kind of a overlap in that discount for lack of marketability traditionally has included the discount for lack of liquidity. We have not passed them out. But then ASA now in its glossary has two different definitions for liquidity and marketability. Whereas marketability is the legal ability to sell, liquidity is the ability to sell without loss of value. And that's where essentially the distinction starts getting made, that an asset may be marketable, but it may not be liquid. For example, the small stocks. And that's where you start seeing fairly quickly that even for fully marketable, registered securities, the market may not be large enough to absorb large volumes at the same point in time. Recent example, JP lost $2 billion. And one of the reasons that is being cited is that the positions they had taken in that particular market segment became so large that they became the large whale. And when the whale moves, the water around it moves a lot. And that's what happens. So if you have a very, and very large doesn't necessarily mean 20%, 30%, could be 5%. Of the stock of a company in one portfolio, you have this incremental impact on the realizable value. You cannot simply dump all of it in the market at a point in time and say we are done and still realize the value that the traditional quotes are for about anywhere from 100 to 10,000 shares of any security. That's what the market maker puts out. Anything above that, the market maker will revise the quote. The bid will go down, the ask will go up. If you are trying to buy a large quantity, you will pay more than what is currently being offered for. If you're trying to sell a large quantity, you will get substantially less than what it is being offered for in small lots. So that's where that gap between those prices, that's kind of my research area.
What is it about research that you enjoy?
I'm fascinated by it. See, my undergraduate degree was in physics. I did not have an accounting background, did not have a finance background. But when I got into my MBA program, I started seeing that the math was very similar. The math of random motion is what's the pricing math in finance. So from thermodynamics to finance, asset pricing is a very smooth move mathematically. The principles are the same and they've been applied, and it was really nice. There's a whole branch of physics now that's evolving called econophysics, where the principles of physics are applied to economic phenomenon. And that kind of is the fascinating area for me. Seeing how things can be done quantitatively, how you can model a process, an economic process, mathematically. And that allows you to rigorously test as to what is happening, why it is happening. You can attribute the causes and look at the impact of those on the asset prices. And that's a fascinating area to work in.
It's also a very highly, I won't say controversial, but highly discussed area within the valuation profession.
It is. Discounts are one of the, I would say, central reason for a dispute. Let's put it that way. I mean, for example, when a tax return is involved, how much, and that becomes a very common issue. Somebody dies, they hold 1 million shares of a publicly traded company in their estate, and the simplistic view would be, sure, what's there is to worry about? Look at the Wall Street Journal, it says the stock is worth $21 at the end of that day. It's 1 million shares, $21 million worth of estate. 55%, write a check for 110 and you're done. Right? Doesn't really happen that way. I mean, that's the problem. Problem is, if you wanted to get rid of those million shares in that one day, chances are you would have market failure. You would not have anyone willing to buy in the open market that large an amount. It will have to be a negotiated transaction.
Sure.
Second, alternative is that you dribble it out. You say, sure, I have 1 million shares, I'll sell 100,000 every month for the next 10 months and we'll be done. What has happened? You have reduced your price impact. Because if instead of throwing 1 million, now you're throwing down 100,000 over 20 days, so about 5,000, 6,000 shares a day, which is a much more reasonable amount to liquidate without considering a lot of price splash. Except now what's happening? If you looked at the newspaper today, you knew what the price was at the end of the day. You don't know what the price is going to be over the next year as you liquidate it. So what you have substituted is the price pressure that you would have imposed on the market. You have substituted that with price risk for an extended liquidation. And the nice thing about mathematical models is that you can identify the impact immediately, distributed over time. Over time, the uncertainty that comes into pricing, you can price that uncertainty.
Okay.
And if you do that, you are able to form a relatively good idea of what is happening. And interestingly enough, it has been that for the last about 2 years, there has been an opportunity to value some of the mutual funds that are carrying large blocks. Now they have to report a realizable value. I've had some, it's good, it's again one of those word of mouth kind of things. A couple of funds now quarterly basis, we are valuing those numbers, saying how much are they worth. And it was interesting and gratifying at the same time. Recently came across situations where we priced those blocks theoretically, and for some transactions those blocks were actually placed with the market, and the pricing that was done by the market makers was within about 0.5% of what we were theoretically coming up with. So it looks like that it's not just that in the valuation side, but on the investment banking side, they are using these more sophisticated models in-house. Most of the funds are doing that.
So right now there are several different models in the public discourse.
Right.
What are a few of those, and do you feel like there's, from your perspective of research, that there's so much discussion about various models versus the fundamental concepts behind the principles needed for those valuation engagements?
See, interesting thing is that for each of, like, I understand you're talking about the 3 models.
Sure.
The Black-Scholes, the look-back put, also known as long-staff, and the Asian average put, also known as Finnerty. Those are the 3 major models currently. And I mean, Black-Scholes has been around for a very long time.
Sure.
I mean, Fisher Black got his this done way back, and then Myron got his Nobel on that. With the other 2, the look-back put and the Asian average put, they are what we call path-dependent options. So Black-Scholes is a very simple option, saying here is the price today, 90 days later what the price will be, whatever the price will be, the difference between those 2. If the price goes down, if it's a put, if the price goes down, you are compensated for the difference. With Asian average and with look back, there is no terminal one number. The Asian average will take the average of prices along the way, and the difference between the ending price and that average price is what you will get paid if the average price is higher than the ending price. So in look back put, the highest price that is achieved over this period will be the price, the difference will be determined from with the final price, and you will be paid that. Okay. Now, all three of these they belong to the same class of options. They're called Margrave options. Okay, Margrave, the original work was done in French. It simply is the difference in the value of two streams of cash flows, the alternatives. So the alternative is that the price doesn't change, the base alternative. You are locking in the price today, right? Now, based on, and these three, interesting factor is that the driving variables for all three models are the same two factors, the volatility and the time to maturity. Those are the two inputs that are used for all three models. So there's no fundamental difference in the information that is being used.
Okay.
The assumptions that are being made about what will the payout be, is it from the highest price reached or the average price achieved or the current price? That is where the difference between these three lies. The two extremes for these are the look back put, which says whatever the highest price is achieved during this period, you will get paid that. So don't worry about holding it for that period. The Asian average, on the other hand, says, all right, let's be friends, let's just share. So half of the loss you will be compensated for, and half of the gain you will keep. So essentially the buyer and seller are agreeing to an arrangement where the buyer, even though he cannot sell, will be compensated for half of the loss that he takes, and will be allowed to keep half of the gains. With a look back put, you don't take any losses, you are fully protected, and whatever the opportunity cost is, that if the value went up but could not be realized because of this restriction, you get to keep that. So that's the best of the world. And then in between is the Black-Scholes option that allows you to take the difference between now and the end. There is no sharing of the loss half and half. You are fully compensated for the loss. Okay. So as far as those three models are concerned, they are very similar. It's the underlying assumption that is different. That's why the payouts for those will be ranked, with the Asian average being the lowest, the Black-Scholes being slightly higher than that, and the long SAF or the look back put being the highest.
For valuation appraisers and analysts, the research is a critical part of the work they do.
Yes.
What are some areas that you feel, from your perspective in the research you've done, that in this current economy, that these analysts and appraisers need to be very much aware of and considering when they're doing these engagements?
So liquidity is becoming a big issue. I would say till about the mid-80s, it was not considered very well. It was assumed that what is marketable is liquid. Then in about 83, 85, you start seeing some work reported in Financial Analyst Journal where the round-trip cost of trading started getting factored in. I think Loeb is one of the earliest papers in that area. And then in the mainstream finance, you see some articles in the 80s, 85, 86 is the first Amy Hood article, and then it kind of died away. But interestingly enough, once we saw now the crash of 2000, 2002 bubble, and then this 2007, 2008, liquidity has become center and forefront. So that is becoming an issue. It's a contentious issue, and it's going to be more and more. The need is going to be to quantify it. Simply saying 1965, SEC ran a study, found 35% average, it doesn't cut it anymore.
What are the areas that you teach at West Virginia? university?
The one course that I teach is mergers and acquisitions. So it's essentially a public company valuation. We have a companion course that one of my colleagues, Paul Speaker, teaches, and that's the valuation of closely held companies. Before the students can take these two courses, they have to take their fundamental courses in finance theory, which are 3 courses. They have to take a course in financial statement analysis, so that's the 4th one. And these two, so these are 6 courses that kind of form a sequence in valuation. So the students that we get pretty well prepared in valuation. And it was pretty gratifying, interesting. The class project this last semester was, as usual, what everybody else was doing.
Okay.
They were valuing Facebook.
Oh, yes.
So they were looking at all the public statements, S1s, S2s, S3s that were being filed with SEC as they went along, and trying to put a value on it. And the students were very worried. They were all getting prices in the mid-20s, 25, 28. There was one student who got a price at 21 for his final report. And there was one that got 42, 43, something like that. But everybody else was clustered between 25 and 30. And they were all extremely worried.
Really?
They were saying, what are we doing wrong? Because they were seeing the second market transactions going in the 40s. And all you can tell them is, look, you're flying blind. Right. So valuation is flying blind. You don't know what is outside. You don't know what is going to happen in future. It's uncertainty. Just like when you're flying blind, what are you doing? You're trusting your instruments. You cannot see outside. You have a horizon on your dashboard that you're seeing whether you are flying straight, going up, going down, and whether you're banked. Okay? So you have to trust your instruments. And the instruments are the information that's available. And based on that information, they were all getting this price around 25, 28, which ultimately the market is sort of getting to there. That number is floating around that number. But at that point, it was a number that seemed too low. But all you tell them is, trust your instruments.
Right.
I mean, we use the Modran's book is the textbook for that class. And we use all the public resources. We have a pretty decent data library at the university, which they have access to.
You're supporting the research, too, of the two of the industry's biggest names, Dr. Pratt and Roger Grabowski. What is it like working with those two gentlemen?
It's really fun. I'm writing a book with Shannon right now. We are working on a cost of liquidity book, which is kind of the parallel to his cost of capital book that he has with Roger. Both they're fine gentlemen.
Yes.
It has been just a pleasure working with them all through.
What would be your advice to folks coming into this profession?
Find a mentor. Work with someone. Because howsoever many textbooks you read, until you see someone who has worked in this for a long while, and that experience has no substitute. I mean, no book has, that is not a substitute.
Right.
Like when I was working on my doctorate, my professor, Dr. Johnson, I was working with her, and half of the time it would take me 2 days of testing a data set to see what might be happening. I mean, she would look at the graph and she'd say, have you tested for this? And that's the judgment that develops with time.
Right.
I mean, now when I look at a graph now, 20 years later, I kind of know what I should be testing for. And that's what happens when you're working with somebody like Roger or somebody like Shannon. They have done this for so long that they have that feel. Looking at the numbers, looking at the journal information, they can very quickly point to the areas where there may be things that you need to dig.
Further digging, yeah.
And that's what, that experience has no substitute. So young people coming to the profession obviously need to be theoretically well prepared, and that is helping. You are helping a lot in that. All the coursework that's being offered. 30 years ago, that was not available. Now, there's a lot of information that's available. But whatever information you have, take that and then work with someone who has worked for a long time. Because that insight is something, that's like the doctoral program. You do become, in some senses, a modified clone of your advisor. Because you develop that insight is by osmosis. And that is why precisely that most universities, the accepted principle is that you do not teach at a university where you get your doctorate.
Okay.
Because what you want is you want cross-fertilization.
Sure.
You don't want to be just a clone of somebody, and then if you keep cloning, pretty soon you have lost all original thought. So you go to another university, there are other people who have come trained from different places, and then you guys work together, and that is what creates new ideas, creates a good research climate.
What do you do outside of research in your own time?
Well, I build small model aircraft and fly them.
Do you? And fly them?
And fly them.
What got you enjoyed to doing that? Was it your family, your father?
I started doing that when I was in high school.
Okay.
And that's one thing that has continued. Small Briggs Stratton engines, 1/20th of a horsepower.
Wow.
These are beautiful things that work, and that's what I really enjoy. Being able, without wires, to take one of those little aircraft up, launch it, and then fly it around, and then bring it back safely and land it. That's the hardest part, but that's the most satisfying part.
How long have you been doing this?
Since I was 15, so at the risk of dating myself for about 30 years.
I want to ask that question. Oh, what's it like living in West Virginia?
Beautiful.
Is it?
Beautiful. This is interesting. This is one of those Goldilocks kind of things. When I was interviewing at the end of my doctoral program, I interviewed at Iowa, which was too cold.
Okay.
Interviewed in Miami, which was too hot.
Right.
And then at West Virginia, which was just right.
That's good.
It's a nice place. It's a small university town.
Right.
Pretty diverse. High schools are excellent. We have a lot of captive spouses.
Okay.
The PhDs that come to the university to teach, typically their spouse is also fairly well educated.
Okay.
Actually, at the Morgantown High School, I believe, more than half the faculty have PhDs.
It's a lot of it.
So for a high school to have PhDs teaching about half of the number is fairly large.
A lot of emphasis on academics.
A lot of emphasis on academics.
That sounds like a wonderful place to be.
It's a really nice place.
Thank you so much for spending some time with us, and
I really
congratulations on the honor and opportunity to work with just some of the pioneers in this profession.
It has been a privilege.
And your contributions, I'm certain, will be appreciated by the practitioners out there looking to be successful in their practices.
Hopefully they will be able to use this material. See, that's one of the things that, as a companion to this book I'm working on, is a data set looking at the volatility as it changes over time, liquidity as it changes over time, and what the impact of that would be on applicable blockage discounts. That's coming up. I don't know when that will be done, but that is something that would become a resource. I look at myself as a resource.
And you have been.
I've been helped a lot by people who have done this for much longer than I have, and in turn I want to return the favor.
Yeah.
I'm available to anyone that has a question. Send me an email. I'll respond.
Very good.
Anytime.
Thank you so much, Dr. Abbott.
You're very welcome.